Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? It's Phil Tarrant here, and welcome to 2025. This is the Pure Property Podcast with Paul Glossop, and I've managed to drag this guy off the beach and come to the studio to record with me because this guy protects his holidays. But we wanted to talk about property, so I said, no worries. I'll see you in the office. In the studio here recording. In Sydney, Australia, there's not much going on here. Everyone sort of leaves the place when the summer holidays happen. We're now smack bang in the middle of school holidays, but a lot of people I know are thinking and talking about property. So what do we say we do? We'd continue with it every single month. Pure Property Podcast. This is 2025. Paul, how was your New Year's? Good?
It was good, mate. It was good. It's good to see that you're in here with your cruise wear, ready to relax.
Well, you need to
ease
be.
into the new year.
Look at me. I'm actually wearing shorts. I don't know if you can see,
Yeah.
but I still put a collared shirt on though.
Proper weatherman outfit.
I still
there.
put a collared shirt on. It's been a good summer.
So far.
I'm only just really getting back into the flow of things at work, and it's pretty cool. It's good to be back. It's good to be back for 2025. What's happening at Pure Property this year? Anything different and special?
There are a few things that are different and special. Some of which I can not divulge.
Okay.
But most of it's going to be more centred around the things that we've always been centred around for well over a decade now. Is trying to maximise client outcomes with property. Very boring.
How long's Pure Property been going now?
A decade. About over a decade.
No.
Yep.
How did that happen?
Well, consistency, doing good work,
Yeah.
and turning up.
Okay.
There's some pretty simple things, and I relate that to property as well, is that you get there 10 years in, 20 years in, and you look at your property portfolio, like, wow, how did I get here? Well, you just stand in the same spot, do the same thing day in, day out when others are doing other things and getting distracted.
Well, just turning up, I found, typically is 99% of it.
That's a good 80%.
Yeah,
in
good
my opinion.
80%.
A
Yeah,
good
yeah,
80%
yeah.
is turning up. The rest of it is, in your situation, a lot of good luck.
Oh, good,
Yeah.
mate. Luck's been good to me.
Yeah.
Luck's been very good with it. You know, it's a business strategy. Luck.
Yeah, absolutely.
But base everything off luck.
Yeah.
It works well.
The Gary player, the more I practice, the luckier I get.
There you go. And it relates also to property investing. That's how we really started off. Was this podcast series was looking at, you know, a lot of the great sporting analogies and how it sort of plays into property. And there you go. You brought one back in.
I did.
Kicking off
That's
2025. You got to do
shoot
that.
from the hip.
There you go.
Damn.
For 2025 this year, you need to bring in one great sporting.
How about you do it, Phil?
I
With
don't
your
know anything about
sporting
sport.
prowess. No, you don't. You're terrible at it.
Let me think. What would I say?
I guarantee if I held a gun to your head now and said, who is Gary player, you might...
He plays cards.
Exactly. He's a card player.
He's a card player. He's
Sure.
one of the greatest golfers ever, Gary Player. Everyone knows that. I'm just trying to think of a good sporting quote. The other ones I know are probably more for sitting around drinking beers. Yeah, very confusion. That's what the property markets. But hey, I saw you're trying to get your books out over before Chrissy for stocking fillers.
There was
Did
a
you
lot
move
of
more?
stocking fillers. There was a lot.
Yeah.
And we've had a new shipment arrive
Oh,
from
God,
our
of course you
publishers.
did.
So we actually have filled up our soon-to-be new office with a storage room, also now full of additional books for 2025. We've also launched an audio book.
Oh God!
So that's an exciting
There
one
you go.
for anyone.
Newsflash. So that's what's
who-
new for 2025.
This is a new one, so this is one of those big things. So if anyone is in the interest in the books, but also looks at it saying, I just don't have time to physically or don't have the opportunity to physically open a book, you can jump onto Pure Property Investments website, which will be brand new and coming live very shortly. But our socials have our audiobook download available on all of our socials as well. So Pure Property Investment, Instagram, Facebook, you name it, everything's out there. You can actually download the audiobook, listen to it
gift.
on the way, and you
Free.
can go to different
Free 50
chapters.
free.
There might be a small handling charge.
So this
that
is how
comes
you
with
can
the
teach your
processing.
kids about property investment. Put it on in the car on the way on your
Choose a
summer
chapter.
holiday somewhere. Choose a chapter, listen
Choose
to
a
it,
chapter, listen to
and
it.
discuss.
Absolutely, and you know, you can relax to the dulcet tones in the evening if you're going to bed. You don't have to listen to the whole thing. Maybe pick a chapter, pick a couple of pages, go through it.
Did you enjoy doing an audio book?
It's about the same as writing the book. There was
Yeah.
times where I enjoyed it. There's other times where I thought, wow, this is a little bit time consuming.
Yeah.
But in general, it does refresh everything that you put to paper a while back and reinforces all the good things.
My fortunately or unfortunately, perhaps, I I always put podcasts on when I'm travelling in the car, and I don't normally travel by myself. I'm normally with a family, but if I'm travelling just with the kids, I always put a podcast on, and they tune into it and they listen. Yeah, and they ask questions about it. They go, "Who's this guy that keeps talking about?" And they get into it. It's pretty cool.
It's funny you say that, mate, because I caught up with I didn't catch up. I was sorting out dinner last night at the house, and we're actually going through selling a property that we've developed a while back, and we've sold one. Now we sold the second, or we're going through the process of settlement. And I was talking to my wife about processes and different logistics that go with it. And Clay, my son, was sitting there, and it basically got to the point where he was asking questions. And he's young, right? He's still obviously nothing of this is firsthand, but it was one of those. I try to have those open conversations in the house. I don't try to ring fence when we're talking about money or talking about processes And he asked me, well, how much did you make on that property? And I broke it down to him to explain, well, here's what we sold the property for. And then his eyes lit up. He was like, wow, that's a lot of money. And then from there, we walked through the processes, A, as to why we sold it, but B, as to what it cost to get to that point. And this was an active development. This wasn't a property that we bought 20 years ago and still hold and are just selling to take profit. And the penny dropped a bit when I explained the fact, and let's say just rounded numbers. We bought a property for, say, this property was circa $3 million, built a high-end duplex for a bit over $3 million, sold the pair for a bit over $8 million, raw numbers. And that was a scenario where I kind of explained that to him just top line. He's like, wow, quick math, Dad, you made $2 million. I'm like, on paper, it seems that way, son. But let's walk through what it costs. And firstly, we bought that property in 2021. We're now in 2025. We 3 years there. Now, I explained to him that we held $3 million in debt on the property initially. I just rounded it down to say 5%. What is 5% on $3 million, Clay? It's $150,000 a year. Okay, now we're at $450,000 in interest costs. It was more than that, by the way, but $450,000 in interest costs. Now we had progress payments to build this $3 million development, and I explained that was, again, I just rounded down to 5%. It was a lot more than that in the end. But again, $150,000 a year, we held that for about 18 months in total. So you've got another circa $225,000 that goes there. So let's say we're at, realistically, in his math, it's $600,000 to $700,000 interest costs. Realistically, it's probably more like $1 million that we had to give to the bank straight away. So out of your $2 million, give away $1 million.
Just $1 million.
Yeah. Then out of that $1 million that you made, then all of a sudden you go say, oh, hey, there's another thing called GST when you develop property. Amazing tax that one.
Yeah.
And it calculated how the GST works and essentially saying, look, when it rounded down, the GST ended up being about $350,000 on that. Then we talked about the fact that, sales agents get paid too out of this whole process, mate. And then out of that, we explained, well, on $8 million, let's round it to say 1.5%. So there's another $120,000 that gets dusted as part of that process. Those two properties, he's been through them. He's seen them. They're all styled, beautiful furniture and all the other things that go with that. That's not free, son. That costs circa $20,000 to hold in both those properties over a 3-month period of time. Worked it all out. When it comes down to it, we spent, as much as this is a side hustle for me, what was on paper a $2 million profit worked out to be, and I didn't even bother talking about capital gains tax and all the other things that go with that, but maybe $500,000, maybe $600,000-$700,000, which is certainly nothing to sneeze at. However, you start to realize that 3 years and risk and time and effort, you start to puts it all in perspective. That isn't a small amount of money to invest, and I'm experienced in that space. I do it on a regular basis, and I've done a lot of them, and I still am. But it starts to refine it all down to think, man,
is it worth it?
Well, this is a question, but it was
so
just
how much time did you spend on that? Really,
yeah,
and 3 years, and that sort of mental. It's not really what it's sort of connected with what I want to talk to you today. It's sort of connected, but let's just stick with this. Is it worth it? The amount of time, energy, and effort, time doing that when you're not doing other things. Could you do more podcasting and write more books?
And it is always a question that I tussle with because I've got 2 active big sites that I'm working on, right? Actually 3 rather, really big sites. One is a big 22-lot subdivision that's already been ongoing for 3 years. Probably got another 3 years left in it. I've got another one that's going to be a uniblock site, which is still going through council and is probably going to have to go to court. And then I've got a townhouse site that's underway, slabs being poured. Is it worth it? Look, it ties in with what I do for a living, and it ties in with my knowledge, and it ties in with my skill set, and it makes me sharper and sharper and sharper every time I do it. So if I was doing that for a living and purely just involved in the development side of things, man, it's a hard way to make money.
Yeah.
And there's no doubt people they're listening right now saying, if I get my hands on $8 million, I'd be more than happy to make 600 grand over a 3-year period of time. I get it. Like everyone's value of what that looks like is different. As a percentage, it's obviously not a great percentage. Now, that site cost more and took more time than what it was firstly projected to do so. But that's property as well.
And that's what happens with developments, right?
Absolutely.
And even the best developers sometimes find themselves in sticky situations, right?
Absolutely. Absolutely.
And it's great when you get it right. It's probably if you get it right.
Yeah.
It usually goes wrong.
Yeah.
For most people, unless you really know what you're doing. And even those people that really know what you're doing, sometimes you just get stuffed.
Yeah.
Like a council change something, you can't do that anymore.
Yeah.
Yeah. We know friends that they buy blocks for the purpose of putting a duplex on because every other house on the street has put a duplex on. And they go, no, we're changing the rules.
Yeah. Well, your house has this caveat, or you've got a wall that's got a heritage overlay on it, and all of a sudden that has to be held, and that gazumps
risky
everything
business.
else. Oh,
risky
massively.
Business. So,
massively.
But the point is, have open conversations. We always talk openly about money in my house. So much so that my kids go, Dad, why do you always talk about us having no money?
Bluey on, please.
Why do you keep saying we've got no money? Yeah. How come you ask all the time? How much does that cost?
You're always wearing these fancy Italian loafers.
Yeah.
You're always talking about we've got no money.
He goes, and why do you always look so poor? They always go, it's because we are children. Why do you always look poor? It's surprising how often I get that.
Yeah,
anyway,
absolutely. You're about to go fly business somewhere, no doubt, but they always sit and coach anyway. So whatever, it's the way it is, mate.
You can't fly as a family anymore. It's too expensive, man.
Yeah, no, it's true. Just buy the plane.
Just buy the plane.
Buy the plane.
That's what I find.
Cut out the middleman.
Jet fuel's horribly priced.
Oh, horrible avgas. What a big problem.
I've got to sell a property just to fly the family. That's what needs to happen these days.
That is pretty much where it's at. I've actually noticed there was some data that came out saying that high-end premium seats are actually on the rise.
Yeah,
but economy is on the outer, and Qantas has got a whole bunch of data saying that the premium, the high end stuff is all the rage.
Yeah,
because these bloody baby boomers are just so
they got so much dough. I went to buy a whole bunch of flights, and one of those Qantas double points things come through, and I went, okay, I normally have a look at it. Normally buy all my flights in tranches, right? For double points and stuff, just to
must be nice.
Yeah. Well, and one come through the other week, one come through the other month, and there's probably a story here,
yeah.
and I went, okay, I'm going to buy 4 or 5 international flights for next year, and I went, man, that's too expensive, like. It's so like Qantas, like so expensive, and I went, I just can't justify the cost. I'm just such a peasant, right? I can't do it, so I didn't do it. I'm gonna pay twice probably at the back end. But I sit there and go, they'll become cheaper. All they've done is gone double status promotions.
Was this for work or was this for pleasure?
Yeah, for work.
Okay.
Double status promotion. So everyone's buying their flight, so they just jack all the prices up. And I just went,
supply and demand, push them all down the same funnel, and all of a sudden you're like,
bam,
drip feed them.
Yeah, much like you see with real estate. Push it.
It isn't dissimilar.
It's not, but it's variable pricing. But property is variable based pricing based on demand.
It is.
That's what property is.
The definition of it.
Yeah.
Things are only worth what you're prepared to pay for it, and what you're prepared to pay for it depends on how many people are prepared to buy at the same time and rent at the same time. It's always been the way.
So it's probably a little bit too early in the year to talk about interest rates and the election and stuff. Everyone still waiting for everyone to get back into business, which usually kicks off towards the back end of this month after Australia Day. So lots of commentary moving forward, and we can try and help navigate it over the coming months on this podcast, the Pure Property Podcast with Paul Glossop. Give some sense of it all. But what is guaranteed is, yes, you live in a democratic nation and you do get the vote, but largely you're going to have very little influence on property markets, the outcomes of property markets moving forward. It's how you choose to orientate yourself and capitalise on those markets moving forward. Now, I'm hearing, and there was a lot of currency around this discussion towards the back end of last year, but now here we are in 2025, everyone's saying it's going to be good buying in the gap between Chrissy and the federal election and or interest rate cuts, and when are they coming? Who knows? There's still some economists who are pretty much saying, look, there might be one, in the coming months. There are still other economists saying, hey, look, you might get a couple this year. There's also some economists saying you might get one or none. So who knows?
Mm-hmm.
But what that's doing is instilling a negative mindset or sentiment with a lot of investors. There's a lot of people holding on to their properties that wanted to sell later part of 2024, which have held on, but they still need to sell. So they reckon there's going to be a glut of properties. Therefore, back to the point around airline pricings, there's going to be a lot more sellers than what there are buyers, and that should put a negative push down on prices. So therefore, time is right. Great if you're ready to go. Running in parallel with that is a lot of people thinking, well, I've held on to property investors for quite a long period of time. I've probably got the capital growth out of them that I have. Some people who invested in Perth, for example, early 2023, late 2022, probably had 50% growth on those properties. Is it time to sell and redeploy that dough somewhere else? So what I really want to get into over the next sort of 20 minutes or so is why and when to sell. And I'll probably preface that with, is it okay to sell? Because a lot of people say, never sell property, buy and hold. That's the strategy. So should you be transacting?
Mate, I get asked this question a lot, and with a lot of clients that are in the position that have held property, whether it's held it for a year, whether it's held it for 10 years, whether it's been handed down through generations, the question of when and if to sell is always a key part, because there's never a definitive answer saying the market's topped out, you should sell. But if I was looking at, there are a number of factors that we always have to consider. So should I and do I sell? Question for me comes down to a few key parts. Now, the first one I always look at is, you just mentioned a market such as Perth. That market hasn't topped out, in my opinion. The data still suggests it grew by 3% in the September quarter. The data, I don't believe, is out for the December quarter just yet, but look, it's still the market-leading growth corridor as far as quarterly annual growth. When we're looking at it on a year-on-year basis, it's been the best performing market for 2024. It was the best performing market for 2023. Will it be the best performing market in 2025? Well, it's slowing, but remembering that came off a very low base and a very protracted sideways movement for a long period of time. But a market topping out and seeing a market go from where it was, let's say a 50% growth period in X amount of time, is that a reason to sell? For me, I'm always a big proponent in that if you bought a property for the right reasons, those right reasons should mean that it's ideally a long-term hold. And when I say long-term, I refer to well north of 10 years. Now, different definitions for different markets, but if you bought a property, I'll give some examples. If you bought a property in Sydney in 2010, 2012, somewhere in that period of time, previous 2 or 3 years was very average. You bought it in that time and you held it right through to about 2015, 2016. You probably saw between, if it was a freestanding established house or even just a red brick decent unit, you probably saw somewhere between 40 and 70% growth in that 3 or 4 years leading up there. If you chose to sell it 2016, that same property, you would have taken that, crystallized that profit, paid your tax and moved on. If you chose to not sell at that point in time, you probably would have seen that market go sideways, bounce around, increase slightly up until around 2019, 2020. Now it saw, more or less somewhere between 5 and 15% growth in that following 3, 4, 5 years. But that same property in 2020 to 2024 has seen another 30 to 40% growth. So when it looks like, I can think of a number of properties that I personally own that I considered selling at different points in time. And I know you've held in Sydney, and I use that example because it's probably a bigger market, more established, but also has had these ebbs and flows, and it's not always a single direction. But the choice of selling crystallizes profit, but it also crystallizes the fact that you're not going to make any future gains on that particular asset. And then if you want to jump back into that market with the same asset, there's obviously very, very expensive transaction costs. The alternative to that same conversation, in my opinion, is that I always like to explore firstly is that, hey, I've bought a property for 400 grand. Well, let's say I bought a property for $500,000. That property is now worth $750,000. I bought that property with 80% LVR, and let's just say I capitalize closing costs, etc. But let's just simplify it to say that $500,000 property had a $400,000 loan attached to it. That property is now $750,000, and let's say I bought that property in 2020, and I'm now in 2025, and I've got this $250,000 that's attached to this equity position from purchase price. 80% LVR on that is going to be circa 600 odd, maybe a touch above. So my first question is always, can I hold that asset, and should I hold that asset as opposed to selling it, crystallizing the profit, paying tax? Now, that question in itself has a whole bunch of different things that flow off, like CGT, like, essentially, am I at the point where I don't have any further borrowing capacity? Can I actually even touch that equity? What does my cash flow look like once I top up that loan based on the rent that's coming from that property? Has the rents grown to then cover the additional amount of money that I'm going to take out of that property? There are a range of things. What I'm alluding to, though, is that the conversation should be had first and foremost, not with a sales agent, is ideally either with us from a buyer's agency perspective to really assess the value of the property, where the rent is, etc. But then secondly, with your broker. Because for me, before you even bother talking to an accountant about what your capital gains tax obligations are, or all those other things that are associated with the sale, is the question is, can I afford to hold this property and take equity out to then perpetuate my portfolio with further assets or further investments? And that's not just, can I get the equity out, but if I took the equity out, can I hold this property, and then can I get equivalent funding to allow me to build my portfolio with something else that's going to allow me to continue to move in the right direction? And what does my cash flow cross-section look like in that instance as well? So there's a few things to unpack there, but that for me is the thought process to go, hey, I've done really well out of this property, I should sell it. Well, that's where I'd say just tap the brakes for a second. Here's the process. I always want my clients to pick up the phone, set up a meeting to talk with me or someone from my team to say, let's assess it all. From there, ideally, we speak to a good investment broker to assess your whole situation, and then figure out not only can you get the money, can you buy more assets, is what is the strategy? Do we actually need to buy more property? Are you transitioning to potentially later in your working career, and are we able to then take that profit, take that cash, re-inject into something that might give you more cash flow? Because you might be transitioning from wanting growth assets to wanting income because you don't have much time left in the working career. You might have retired, or you might be the complete opposite, saying, I'm looking to get super aggressive and just go through acquisition. So that's where I see it.
It sounds complicated.
A little bit, yeah. but I mean, I genuinely discuss those different choices every day, and I think once you go through it all, it's pretty systematic. It's not ad hoc. It's not subjective. It's going through some pretty succinct questions and getting the answers from my clients, my investor clients, to say, okay, where are we? What have we earned? Yeah, are we at the end of what we need to get you to your goals, whether it's cash flow, whether it's equity, whether it's total net position, whatever we're working towards? How much time do we have left? What's your borrowing capacity? A range of different things to go with that. But as I've probably alluded to, it's not just me. It's also the team of people around you that we want to then lean on, that professional, and get those opinions. And what it means is that the investor clients of ours are just, they're always in check and up to speed with all the things they should be considering, as opposed to just making a decision on a whim.
Yeah, and there's always a catalyst for someone to consider selling, I would imagine, and often that catalyst might not align with market conditions. So it's I don't know how many people always nail it and always sell right at the right time. Most people sell at the wrong time, where you think you're going to get a certain price, you never get it, right? No. It's just always the way it is, right? That's one of the reasons why a property is called an asset, because an asset is something that you can realise the value of at a point in time. Property's tough because unlike shares, you can liquidate shares today at whatever the market is. The market will buy it at market rate.
Correct.
Property takes longer to sell. It's a lot more illiquid. So the immediacy of realising the cash in your asset takes a lot longer in property, which has pros and cons as well, right? We can chat about that. But I don't know anyone who's always sold at the right time. It's like, oh, it's funny you sold it 2 months ago, or maybe I should wait 2 more months and sell it then. And if you're sitting there thinking right now, back to the earlier point, how do I redeploy the equity growth I've had in my portfolio into other markets at the right time? That means you may be selling in a in a market with a glut of properties because there's a whole bunch of other people selling. Therefore, that's going to have a negative price pressure on it. So you've got to really understand and be true to yourself what the price of the property is going to be at the point in time of sale, and probably expect it to be lower than what you want.
Yeah, mate, you raised some really good points there. And I'll bring up an example of someone I actually spoke with yesterday, and this is a classic example. And I know she actually listens to this podcast, so she'll probably be aware of the fact that I'm talking about her. And I don't think she'll have a problem because obviously I'm not going to use names, etc. But it's not a bad situation, but it's a situation where there's a few things to consider. This is someone who will be a client in the future. We've had a couple of conversations, hasn't engaged us yet for reasons that they weren't ready. Now, the fact of the matter is they live in Perth. They have a home in a nice area of Perth. They've done an extensive renovation throughout this year. That property is almost finished as far as renovations are concerned. I wasn't part of those conversations, but that's just what they did, that renovation. In the meantime, the last couple of months, it was about 6 months ago, they bought, so they're about 5-6 years left in their working careers, mid-50s. They've bought an off-the-plan property. You're still in Perth. They intend to downsize too. Now, there's a fixed price on that property. That property is going to be, let's say, circa 600-700 grand less than what they're valuing their home at right now. And the intention is that off-the-plan property will likely be completed and finished and ready to move into by Q2, Q3 next year. So they're going to finish this renovation. They're going to then sell that property and move into this new property and ideally have a chunk of change left over, circa 400, 500, 600 grand. Yeah. Now, the difference on paper is 400, 500, 600 grand. They've paid for this off-the-plan property. There's a fixed contract. There's a price. That's the price they're paying. That's not changing. What is a big variable is what they get for their home. Now, that is where you've got huge amounts of subjectivity. And when it comes down to it, what they also want to do, and the reason why we're involved in this conversation is they want to also buy an investment property to further their portfolio before retirement and before their income drops off and they can't borrow money. My position on that, and still is a position, is that we, as much as I could say no problems, they have cash available and borrow capacity available to go buy a property of $500,000 today. I was very reluctant to want to do that. And my position and the summary to them is that we're going to hold off buying anything, because if we do buy that now, you could be in a position where what you think is X amount of a sale price and you end up with 500-600 grand in surplus to then actually buy this investment might be far less. And if we buy this investment now, you have already committed to this off-the-plan contract. And let's say we fast forward 2, 3, 4 months' time when you sell this home, if you don't get the price you want, you might have to actually sell this investment to then settle on that off the plan. And the order would be
or sell the
wrong.
off the plan.
Well, but then they're homeless.
And then they're homeless.
Yeah, so I'd obviously, you'd be going down the former rather than the latter. But regardless, they'd be setting themselves up for a very, very tricky situation. Now, is 6 months going to determine a massive difference in the market and we're going to lose out on a huge amount of gains in the property investment space? Very unlikely. Property moves slowly. So anyone who's trying to force you to do something today, I'd be questioning why. A property, good properties come up and you have short amounts of time to move on them. That's a different conversation. But the difference of 6 months versus 2 months versus 12 months, it doesn't really move that quickly in general terms of property. But I guess my point here is that out of that conversation they had yesterday, we didn't bother saying, here's what we're going to buy and where we're going to buy and the price point, because really that's unknown. What we did get out of that is that they need to sit down with a good quality broker who understands not only the owner-occ and off-the-plan space, but also can strategize the best way to plan moving forward. So they've got that plan ready. The step is finish the renovation, sell the property. Once they've sold, they know exactly what they're going to have left over. They already know what they're going to be needing to settle on this new home. They're ideally going to get a 12-month lease back when they sell their home. That's going to be a stipulation in their contract. Then we've already got a meeting set up for March next year. So ideally by that time, the property's been advertised. They might have had a contract already on the property. We know what to work with. Then we can go and buy because they've sold, they've spoken to a broker, they've got a price, they've got a sale price, they've got a purchase price, and we've got a plan. Now that's a classic as to when to sell, why to sell, and how to time it correctly.
So what are you talking about there? And anyone that's sort of worked with me will know this is how I sort of orientate myself, which probably annoys some people, but it's just the way my mind works.
You don't annoy anyone, surely.
No,
never.
Believe it or not.
No.
And it's nice, like that. All that theoretical stuff is good, and all the what ifs, and that's just called workshopping something, right? Like I'd thrown ideas around and coming up with a position or something or other, but that's all good. But the secret is in the execution. And when I think about execution, I always link execution with sequence. And the sequence is critical with everything that you do, right? Everything is contingent on something else. Mm-hmm. And often the contingencies might have different arms of it. You know, it's like a big flow chart. If you looked inside my brain, you'd just see a sort of flow chart, right? Which goes, if this happens, this happens. If this happens, it's not nice to live with, right?
I was more picturing the bird drinking the water.
Oh, that as well. That's right on the other side. But so this is being comfortable with goals and objectives, which is one end of the process, and then the strategy and the tactics on the other side, right? Some people are good at one thing, some people are good on the other stuff, right? So you spoke about a lot of ideas there and all the what is, right? Okay, you got to put that into action. Yeah. Everything is contingent on everything else, and therefore you need to get and set up your sequence right. And often it's really, really hard to actually fill in the gaps. And I always write it down. I always say, here's the start point and here is the end point. And then I try and work out all the bits in the middle. And yours is like, if this happens, what happens? If this happens, what happens? You need to do that.
Absolutely.
You need to do that. And what I find is a lot of property investors might not, because they don't do it usually, they might not have the rigor to actually do that themselves. And that's where a buyer's agent or a broker or a really good accountant can help you out with this. But my recommendation is write it down. Write it down, draw arrows, draw little boxes. I sit there and go, oh, you see me do it. Like that happens and this happens and this happens. And then you actually get a blueprint. Like that scribble is a blueprint, and you can actually follow yourself through the journey. You know, you go, okay, it comes down this chain, comes down this chain. Are all the different what ifs and all the different end products, am I satisfied or okay with all of them? That one might be the ideal one, but I'm okay with outcome 2 or outcome 3. And if it is, you can go down the process of doing it. But it's going to allow you to control what you do and when you do it, and then what the main points of inflection are during that process. And you can capture that. You've got to be comfortable with this, because that situation you're talking about there, that can end badly.
Oh, absolutely. And
that can end badly.
Happens.
And the worst case would be they sell their property for a lot less than they do, and they can't complete on the off the plan purchase. Yep. That off-the-plan purchase is undervalued at the point of completion, and they don't have enough money, therefore, to complete that. Then they need to sell it, but there's a whole bunch of other people selling that same thing at the same time, and they can't sell it. So they're stuck with off-the-plan purchase. They've sold their principal place of residence. The investment property hasn't worked out or haven't got the capital growth they needed. Buyer beware.
Absolutely.
Seller beware.
And you raised probably another really, really good point there, Phil, is that if you get to the point of saying, okay, look, I understand all the moving pieces. I've written it down. I have a good mud map of what it looks like.
It's a mud map.
You need to take action from that mud map, because that's the problem I find, is that you get to that point, but what does take action mean from there? Like, you can have an idea and you can explain that idea to 10 people and they can get an understanding of it as well. But realistically, that process, all those different contingencies, you're not the person who's going to dictate these outcomes. You're going to be the person who controls and drives the outcomes, but you need to then contact the broker. You need to then contact the sales agent. You need to get an appraisal. You need to get an understanding and say, I probably need to get this property on the market as soon as possible, with the knowledge that the agent knows that I also need to make sure that whoever buys this gives me a 12-month rent back opportunity, because what I need to do is I can't, even though the Perth market, as that example, is not in a bad shape and likely won't be for the next 12 months, you fixed a price on this and the other asset will probably do okay. You still can't be sitting there thinking, okay, the day I get the call from the developer with the 30-day to settle notice on that property, I can't all of a sudden think, okay, I'll get it on the market, and all of a sudden, wow, something's incorrect. Whether the market's changed or I perceive the property value to be incorrect, you need to get this moving.
I've got to say, there's got to be curly bits in this.
And, massively.
But that's property. That's okay. There's got to be stuff that doesn't work out. You're going to go, it's time to sell the property, and no one wants to buy it because the market's moved, and your sentiment was, well, 6 months ago the property was worth this, now it's worth this. No, that can't be true. It's a good case that will be that. And that's not anyone's fault. That's just
it's the process.
Property.
That's and that's part of the decision. If you commit to off the plan, there are things that will actually eventuate from committing to that contract. There are things that, and they were considered. And this probably goes back to the example that I was talking about a second ago, or a few minutes ago now, when I was talking about these properties that we're selling. We also ran through the scenario. We sold one for a really good price. The second one, we put it straight back on the market to try and sell. That second one was more attractive, north facing. We ended up getting a price which I think was okay, probably not as good as what I would have hoped.
Did you sell the second one for more than the first one?
In dollar value, a little bit more, yeah,
Okay.
but less than what I thought it was probably worth, considering what we got.
So you reckon it was a 5% premium on the south one, or
yeah, it
a
was
bit more?
probably somewhere in that 4 to 10%, somewhere like that. But beauty is in the eye of the beholder. It is what it is, right? I'm a price taker when I sell. Regardless, whatever I think it is, the market tells me what it's worth, and we got what it's worth because that's what the market was prepared to pay. But we also ran through the scenario of actually not selling the property and renting out the property. And again, going back to all the things we have to consider, we took a price on the first property. That was fine. That cleared a lot of our debts and we held a lot less debt. So technically we could have rented out the second property circa $2,500 a week. And that would have then allowed us to cover our mortgage interest repayments, no problems. But what that wouldn't have done is cleared the mortgage on the property. Now, the problem that's contingent with is that I mentioned also I've got a townhouse site that I'm actually privately developing at the moment as well. Now, the bank, the entities were the same entities, so they're connected to a similar company. So therefore, the bank said, well, you tapped out on your borrowing capacity within that company, so you're only going to get your construction loan approval upon that contract being exchanged. So that kind of then came back and we thought, well, we could probably find funding in a different way to get this construction loan moving. We've got a really good rate on that construction loan with a major bank, and that in itself is valuable. We ran through the scenario saying we go through a tier 2 lender, they were going to put about a 2% premium on what we would have got from a construction loan. That is a cost. So after looking at all those scenarios and thinking, well, do we take a price which is less than what we thought this property's worth and wait 12 months, put it on the rental market, ice it for that time, just cover the mortgage with what the rent's going to be? Do we do that? And then we sort of, actually rolling through all this, we've got a bird in the hand, we've got a signed contract with a 2-week settlement, which is happening. We looked at it and said, you know what, it's probably still best that we sell this property. And they're still the scenarios that we look at. It wasn't just, we didn't have necessarily the intention to buy a property, build a duplex, sell the duplex, make money. It was more, this is part of a process. And privately, I mean, I buy a lot of passive buy and hold assets for my own portfolio, commercial as well, and then development sites in addition. Development sites aren't just a process of buy, sell, buy, develop, sell, buy, develop, sell. It's certainly ideally buy, develop, hold a portion, move on, take equity, hold that stock and push it through. And we've got a number of projects that we've done that. Some projects, to your point earlier, Phil, some projects we have a better margin than others. The market's better. For whatever reason, we get a price. Other projects, it goes the opposite way.
Sometimes you win. Sometimes you really win.
Yeah.
Sometimes you lose.
Yeah.
That's developing. And a lot of it is market contingent.
Absolutely. And again, it goes back to there are so many variables, but when you talk about those mud maps and those processes, I sit down with my development partner who's town planner, architect, very process orientated, and we do sit down and we go through our Gantt charts, we go through our timelines, we go through our funding position all the time. When I say all the time, probably every couple of weeks we go through a deep dive, and probably every couple of months we also then include our banker into that because they have to have their inputs because we have assumptions. Sometimes those assumptions are miles off. And then we also, I mean, I'm a buyer's agent. I know markets, I know market values, I know valuations. That helps because I can always have that input there. But there are just so many different things that are always considered, and this is part of, do I buy? Do we need to buy? Can we hold that property, get the equity out? And that's where this whole conversation, whether you're developing, whether you're passive investing, whether you're going from your first property to your second or your 10th, and ideally trying to take a massive chunk of equity out across a number of properties to go and proliferate 5 additional investments, whether you're transitioning from a 30-year-old to potentially a 40-year-old position, or if you're going from age 60 to retirement and needing income, these are all the things that we have to always consider.
Complicated. Now, you said something there, and we've got a little bit longer, and I want to talk to you about it. We're talking about selling, right?
Yep.
And why to sell. We've had a couple of case studies there. A lot of people I know inside of property investing, and I'm starting to see a theme emerge, and I want to share this with you, and I'll get some colour on it. Every property investor I know doesn't want to stop at 1 or 2 properties. And people tune into this podcast, and which is part of the Property Investment Podcast Network, Smart Property Investment. Everyone wants more. And when they start, they're like, they love it, right? People go, how many? It's the only thing I really see people go, I love property. I'm passionate about property. I love property. I go, why? Like, but people genuinely are emotionally connected with property, and you don't really see it. People to me seem more in love with property than what they would do sport. You know how you get passionate sports people, you get the same in property. So they want to do properties that they don't want to stop. So then they start thinking more. How do I propagate more? Right, and that's really a common thread of all or property investors. But what I'm seeing emerge when it comes to when and why to sell, a lot of it is to continue the proliferation of building a bigger portfolio to create more optionality at a point in time when you choose to retire. And there's a bigger theme emerging. You see it if you look in your social media. Everyone's now talking about how to retire with X amount of passive, $100,000 passive income, 150,000. Like that's they're all big headline stuff. Like, yeah, whatever. Everyone's number's different. But there seems to be an emerging trend of people now having this realization, and it's only really the last couple of years, now more than ever, that you sell residential property to buy commercial property.
Yeah.
And it just seems now that's been ingrained as a standardized mindset for property investors. That's what they do. So rather than going, I'm going to build 50, 60, 70 resi properties, most property investors now are having that thought process of going, I've got 4 or 5 resi, it's time to go into commercial. So people are moving into commercial earlier in property investment than what they used to do. And I'm seeing it more and more and more. And you see there's a lot of, property investors, resi property investors shifting into commercial. So they're selling resi to buy commercial and chasing better yield, better cash flow.
Yeah.
Are you seeing that?
I think people are wondering, how do I transition to cash flow? That's probably more the mindset is that, my disclaimer on this is, and look, I'm happy for people to write in with angry letters to say you're wrong and all the other things that go with it.
Where do you send that to?
You,
okay.
Certainly, because you're the only one who gets hate mail. I get joyful Santa Claus style mail, not really. But the reality of property, Australian property, resi versus commercial, is that if you're starting out in commercial is a very hard and realistically very high capital intensive way to do it. And you're usually going to be starting at the bottom end of the ladder, and it's not the best place to start if you're looking to
You're talking the asset selection.
Talking the asset and talking about the tenant stability, talking about the net returns, talking about the downside, talking about length of leases, a whole range of different things. So when it comes down to it, what we always want to say is like, well, the side of the growth side of the equation, I'll leave that off the table for a second. Yeah. But it's also a lot easier to get the banks to play ball with you. And you've got to remember that this game is as much a game of finance as anything else. And if you can't get the finance, your ideas, your thoughts, your strategies are useless. So when it comes down to it, you've got to find the way to get the money to start the ball rolling. And that invariably, and there is a reason why banks are happier to lend to residential investors than commercial investors when you're talking about LVRs, when you're talking about rates, when you're talking about the amount of banks who actually play in that space. It's more predictable, it's more forgiving, and there are essentially far more levers that the government has to influence where and what residential property does, and the banks are on board with it, and obviously they make the majority of the money in residential mortgages. What I always look at is, and when we transition from hey, we've got a great resi portfolio, but we're now considering we need more income, the question still starts as, do we need to sell to transition? Well, if you're going to take equity out from, let's just say you spent 15 years building up a 5-property portfolio that now is worth $3 million and has a debt of, let's say, $1.5 million. Let's just run it at a 50% LVR, and you've got a decent position, and you might have another 10 years until your end of your working career, and you're like, okay, well, ideally, I now need to think about, and this is excluding super, let's assume super's invested elsewhere. We need to then transition this portfolio because it probably is only still slightly cash flow positive on those numbers. Realistically, if it's resi at $3 million, debt of $1.5 million, probably netting 3 or 4% after all said and done across the $3 million asset base. So the question then comes to say, well, how do we transition it across? Well, the first position is, can we get that equity out to invest it over in commercial without selling anything? If we've got 5-10 years left, I'd probably say it's still enough time. Most of the time, there is not the capacity to do so. But even if there was, let's say you can go and take $500,000 out of that position. So you go from a $3 million asset base, you could take your debt from $1.5 to $2 million, and you take that $500,000 as a deposit, let's say for a 70% LVR, for maybe a $1.5 million decent commercial property at a 6% net return. At those numbers, and I know I'm running through numbers here, so people can probably go rewind and go through these numbers again if they want to and listen to it a few times, but if we bought a $1.5 million asset, took your asset base from $3 million to $4.5 million, but we want a really high cash flow delivering property to give us more income down the track, and we're not selling We take our debt, this $500,000, we're going to pay, let's say 6% interest on $500,000, 30 grand a year on that $500,000. And then you're going to go borrow another $500,000 from the bank. So we've got $1 million in debt, 6%, 60 grand a year. You've bought a $1.5 million commercial asset at a 6% net return, 90 grand a year. Okay, so let's just run off those numbers, possibly somewhere around about that. You're probably going to have another 10 grand in expenses, but what you've done via that process without selling is you've essentially increased your income by 20-ish, probably grand a year once you factor in the additional closing costs, etc. So that's a way that I would say you go from transitioning from building up a resi portfolio over a good protracted period of time, being somewhat active, but not being ridiculous in thinking I'm just going to buy everything and anything I can, regardless of where and what I'm buying. I'm just talking about numbers. And a lot of people get caught up in how many properties as opposed to the value and the quality of the property. And for me, that's a key part. Do not get too bent out of shape when you're talking about the number of properties. It's a value versus the debt and the income. But that's a process to go from resi to commercial or income generating assets without selling. Now, the converse could happen there where you say the bank says, no, you can't touch any more money, but you still want to buy that $1.5 million assets on exactly the same process. At that point, that's when you have to have that conversation that we talked about earlier. Say, okay, we've exhausted the don't sell option, and that's not an option in your situation. We then have to go back to think what properties are going to give you the best outcome, both on growth, but also cash flow and minimal maintenance and vacancy and all those things out of your 5 properties that we discussed that are worth $3 million. Which ones have the most amount of equity that's available? Which ones have done the bulk of the heavy lifting and maybe don't have the same propensity for growth over the next 5 to 10 years? And then get some advice from your accountant from a tax position to say which ones, what entities are they held in, which is going to be the best to sell, which markets are the best to consider selling in. And I have a lot of those conversations with clients who we've had for a decade because they're in that position. And then it's that stage we say, okay, well, we can't go and buy that property today, but we can go through the process of starting the ball rolling to free up that same $500,000 in cash by selling this and this asset. It takes your total exposure from $3 million maybe down to $1.5 million, but then your debt drops to a much lower position. You recycle that cash into that same property, and then all of a sudden you've got a much higher net return again as well. So that's the other end of it when borrowing probably isn't available.
So is it a good time to sell? Because normally the question is it a good time to buy? And everyone goes, it's always a great time to buy if you've got the right blah, 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 blah. Is it a good time to sell?
I look at it this way, Phil. Like if I'm wondering when a good time to sell is, it's like what is the money market going to give us ability to borrow more money? A good time to sell realistically, in my opinion, was probably, depending, and this obviously is subjective because it depends on what you held and where you held it. But when the money market started to tighten up, you usually look at it to say, okay, well, if you need to sell, you probably want to sell before that happens. And then all of a sudden, mid-2022, we saw a huge amount of interest rate increases, and then money got more expensive and it got harder to borrow money. And, theoretically, that should have made the market stagnate, which didn't. And some markets have gone kaboom because you realize that the money markets aren't everything. But on the converse to that, I look at it right now is that we're probably entering into an interest rate easing cycle.
Yeah.
And what does that mean? Well, that means that money's going to get cheaper and more accessible for more people. So if you're selling before that happens, you're taking a price before money gets cheaper and more people are able to actually access cash and probably pay more for your money. And secondly, you might actually be able to borrow more money in 2 years than what you can right now without anything changing in your portfolio or your net position or your income, etc. So I would personally say that selling now versus selling that same property, assuming no growth, assuming no rental growth, assuming no income growth, is actually going to be better in 2 years' time.
Okay. There you have it.
Yeah.
What's your hottest tip for 2025 property markets?
But buy predictable.
Buy predictable.
Buy
there you
predictable.
Go. That's pretty simple.
Yeah.
So this is what you want. You want simplicity in life.
Yeah.
Because you ask a lot of people that question, I'll give you, Who's that? He goes,
I actually think it was Fast Forward or Full Frontal back in there. There was a political reporter.
Yeah, those puppets.
there was those
puppetry. Yeah, what's what they call something?
The two guys, Sesame Street sitting out there.
Yeah, by predictable.
I think by predictable. But by saying that, I mean there are markets right now which have, over the last 30, 40, 50, 100 years, been some of the best performing markets consistently, decade in, decade out. It doesn't take a genius to figure out where they are and where's affordable right now and where's predictable. Avoid the temptation of glossy, shiny things in areas which you have no idea about, but you're relying on the opinion of one or two people.
Or the cab driver.
Certainly the cab driver. Blessed the cab drivers. There's probably more Uber drivers these days, but I don't get much conversation out of Uber drivers, so it's probably
I don't deliberately don't take Uber because I like to get the intel, the word on the street from the cabbie. Cabbie always tells you what's going on.
Yeah.
They always know.
Give me your last cabbie conversation hot tip.
Last night.
Oh, here we go.
He was angry.
Write this down, people. When aren't they angry? Particularly on night shift.
The hottest tip, he was complaining about the traffic at 10 o'clock at night crossing the Sydney Harbour Bridge because of all the roadworks that are taking place.
Okay.
All this infrastructure is ruining Sydney, he said.
Ruining it.
Yeah, ruining it.
Okay.
Saying that they're disrupting everyone's ability to make money by jamming up the traffic, is what he said. So he's a NIMBY type of guy, I reckon.
It's a very niche problem for a niche industry.
It is. No, well, yeah. If anyone's not familiar with it, there's a fair bit of infrastructure work happening in Sydney at the moment.
A little bit, and also in Brisbane, Melbourne, Perth, Adelaide.
and it's disruptive.
It is.
And
progress.
And it's
progress
good.
isn't simple.
No, and they're building this new tunnel linking the out Anzac Bridge to Military Road there, and they're completely changing the Moringa Freeway. Like it's a really impressive bit of infrastructure that will set the city up for years ahead.
Yeah.
But the cabbie wasn't particularly happy about it. So there you go. That's what the Uber driver wouldn't have told you that.
No, he wouldn't have.
No, they don't talk. They just look at their screen and drive.
It just charges you basically per minute.
And whenever I'm traveling internationally, I always take the taxi. I never take an Uber because
I've known that about you, Phil.
Since
the advent of the Uber, you've always been anti-Uber.
I've always been. I like if I'm in a new city, I want because the cabbies know everything.
Yeah,
they know where everything is. They know how to get around. They know all the streets or whatever. And you go, what's that? What's that? What's that? How does that work?
Unfortunately, Phil, though, they won't be around.
You're going to get driverless cars, and then but at least then a robot might go. To the right is the, whatever. Anyway,
I'll end it with one thing.
But there's a property thing. You need a guide.
You do.
You need a guide when you're doing anything,
and
particularly if you're doing anything new.
I was at a family.
Do you love
how
I always bring it back?
Oh, well, I'm going to bring it back as well with another way, which is very similar. And I was at a family event not so long ago, and a family member needed to get to the venue that we're going to, and from that venue they were there. And we finished the event, and we needed to get to a restaurant nearby just to have a quick bite to eat and a celebration. And from there, it was about 3 minutes away. Now, this wasn't a conversation between an Uber or a taxi, but it was a conversation on how do I use my phone to navigate to where I need to get to. Now, standard process for anyone who's listening, I dare say, would be open up Google Maps, Apple Maps, Waze, whatever you're going to be trying to figure that out in, or even just any kind of app on your phone, and then you can look at it. This person doesn't have that phone, doesn't have a phone, but has a Gregory's.
Old school. Brilliant.
This is where the story gets funnier, though, because I had to go through it. I had to use my memory to figure out how to actually show them where it is and then follow the map to A2 to there and then join it to the next map where it showed me it was about four pages in there. Where we were going to on their Gregory's didn't exist because that was a 2013 Gregory's.
Yeah, there you go.
I asked the question, I was like, how do you get to places that are new? I keep the new one at home.
So what they said.
So they plan out their maps at home and go, but the fresh one's always at home. That's the current one. And then the out-of-date one sits in the car. I'd probably do it the other way around if I was the person.
Maybe.
But tried and trusted, I tell you what.
There's a lot of people still using Gregory's in property investment.
There is.
Metaphorically, because they don't know where they're going and where they're going doesn't exist on it, right?
It's true.
But buyer's agents are the taxi drivers of the property industry.
Ideally.
They're your guide. They know what's going on. You want to know what's going on anywhere? Speak to the cabbies.
And internet's your Uber, I believe it, because if you want to find some sort of validation of your opinion, you'll find it on the internet.
But that's data. Essentially, that's data versus ground truth.
Yeah.
You need to know the ground truth. And the people that know the ground truth are the people who tread the ground.
You're right.
And they're observant and they're connected and they're curious and all that. That's your cabbie.
That is your cabbie.
Your Uber's just following the data. Yeah. Anyway, that was not a bad analogy.
Not bad. Not bad. A little confusing.
Not
I'm still a bit confused.
No. Smart people will get it.
Okay.
Yeah,
well,
don't worry about
that's
it.
clearly
Smart people like me will understand it. So
well,
don't
bring
worry.
That back to
don't
the Smart
panic.
Property Investment Show, not the Pure Property Investment
podcast.
podcast.
But this is all about pure property, not pure taxi. But thanks for coming on your break, mate.
No,
it's
mate,
good to see you. Good to see you. We'll line up some good guests for 2025.
Absolutely.
Cool.
No, there's going to be some good ones.
Including doing some bits on development, from what I understand as well, and breaking down some of the
Fast 50, those who are interested.
So Fast 50 back, is it?
Fast 50 will be back very
soon.
It.
Yeah, normally comes out next month in February.
I believe so. And we'll probably try to do a deep dive into what the Fast 50 last year looks like. We did a little 6-month break, but I tell you what, there's some crazy numbers out of our forecasts and predictions
when we launch it, which will be shortly, because there's a lot of work happening in the background, obviously, around getting all the different recommendations. The difference between the 2024 to 2025 report, and remember, this is where to put your money today for the best capital growth in next year. So what we're talking about really is
2026.
Is the Fast 50, which will be launched in a month or so, is for next year. So it'll be a 2026 report. The 2024 to 2025, there was a fair bit of similarities.
Yep.
The 26 to 25, I think you're probably going to see some different.
There will be some new entries, and you overlay them all. And now we've done this for a few years, you start to see that there is themes, and also the consistency isn't necessarily just keep buying the same market. Yeah. What I will say though is that we reviewed this mid last year. Is that out of our 50 forecasts, and I think Pure Property Investment had myself 12, and my team,
12, 14.
12, 14. I think out of the top 10. Out of 10,000 suburbs in Australia, the top 10 performing, I think we picked 8.
It's not bad.
It's not bad. Good size.
Not bad. All right. Are people there to answer your phones at the moment?
Absolutely.
You guys,
we're fully fledged. Our team are rolling.
So you're still on holidays, but the team's working?
Well, someone has to take holidays.
Yeah, this is true.
I took a leaf out of your book, Philip.
Yep.
purepropertyinvestment.com. You also go there for our paperback book and our audio book, which will be available for you if you don't want to read books. Jump on our socials at Pure Property Investment, Instagram, Facebook, etc. You can grab a copy of the audio book. But if you want to sit down and really plan out, even if you've got thoughts on buying, selling your existing portfolio, how to strategize to maximize what you're trying to do in the future, jump onto our website. You can click schedule a meeting today with either myself or someone from my team pretty much immediately and go through all of those questions and much, much more.
Brilliant. All right. Thanks for your time. And I hope everyone's still enjoying their break. If they're not yet back at work, put those podcasts on in the car. Educate your children. There's a hot tip. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.